Let's dive into another topic here, real estate. We haven't really talked about real estate much on this show, and a lot of you have highly appreciated real estate. I know 2008 just seems like yesterday, but it was 10 years ago, and then now a lot of the property values have come back, and some of you might not want to sell because of the tax burden. Big Al, let's break some stuff down here to look at, first of all, an outright sale. What should people do if they have a highly appreciated asset? And, you know, if I look at this example, this real simple example, I probably wouldn't want to sell it either.
Yeah, that's the problem. A lot of people like to invest in real estate because it does tend to grow over time, particularly on the coast, like we're in San Diego, for example. But this is why people don't necessarily want to sell. And there's a lot of numbers on here. Let me break it down real quickly. So if you're selling your property for $700,000, so that's your sales price. Now, what did you buy it for? You bought it for a couple $100,000. But you've been depreciating it. Depreciating it means that you're writing off a piece of the property each and every year. So let's say $150,000 is your depreciation, so your cost basis, what the accountants call it, is $50,000. So the difference between these two is your gain. Your gain is $650,000, and your federal tax in the highest brackets would be about $155,000. Now, if you live in California, you might add another $80,000 or even $90,000 on top of that. So you add these two together, Joe, you get close to $250,000. You don't really want to sell.
Right. It's like, okay, well, here, I'll just hold on to that property, because there are strategies that you can do, which a lot of you do. You just hold on to it until you die, right? Because there's something that's called a step up in tax basis. So if you pass away, your heirs can receive that asset, sell it the next day, and pay zero tax. But let's say if you need additional cash flow, let's get into two other strategies. Maybe that rental property is not producing the cash that you want, or that you're getting older and you don't want to maintain it. There's a 1031 exchange, and then there's also something that's called a tax-exempt trust, or maybe a charitable trust. So Big Al, let's break down what a 1031 exchange is.
Yeah, let's start with that. And the reason you might want to do that, now you're exchanging from one property to another property, but maybe you're doing that because you want a property that has better cash flow for retirement. So let's talk about the requirements. So first of all, it has to be the same taxpayer selling and buying the property. Seems obvious, but sometimes it's in a certain entity and you want to buy it yourself. So it has to be same entity. You have to have like-kind property, which is pretty generous. It just needs to be a rental. You've got, when you sell your property, you have 45 days to identify up to 3 replacement properties, and then you have 6 months after close of escrow to actually buy the replacement property. It needs to be greater or equal in price. And if you do all those things, you take the gain of the old property and defer it into the new one and pay no current tax.
And so I think why people would do this is that, all right, well, here, I have this property. It's not really performing all that great. And then so what do? Maybe I find an apartment building that has really good cash flow. So I take this one unit and then I exchange up. Now, what happens if you exchange down, right? So you go to a property that's $700,000, you exchange it, you don't pay any tax, but the property's worth $600,000.
Well, that's a good point. And so in that particular case, to use my example, then $100,000 would be taxable and the rest of the gain would be deferred. So it's a partial exchange is what happens in that case, Joe.
So here's another cool strategy. Alan's going to write this out on the whiteboard, but it's called a tax-exempt trust or a charitable trust. So maybe you don't want to exchange the property at all. You're like, you know what, I'm done with real estate. I just want to sell it. I want to get rid of it, and I want to have more liquidity, and I want income. So there's something that's called a tax-exempt trust. Al, why don't we illustrate what the heck that is?
Yeah, Joe, and I think this is an important one. I think a lot of people, once they learn about this, they get real excited about it. So let me explain. I'll try to do it on a very simple level. So you set up a tax-exempt trust. So I'm just going to call this tax-exempt trust. And you've got your property over here. We'll say property. You contribute that property over to the trust. Now the trust owns it. And when the trust sells it, there's no tax to pay because it's a tax-exempt trust. So you have the entire proceeds here without taxation. Now what you get is a lifetime earning stream year after year. You get payouts from this trust. And the payouts are part income, part principal, part growth of the trust. So the reason it's tax exempt is that when you pass away, roughly 10% of what's in this trust goes to charity. That's how you get it to be tax exempt. But if you think about it, if you're in a 30% bracket or higher, if you're saving a 30% tax rate now in exchange for giving 10% away later. Now, I know I've oversimplified that, but this works for a lot of people because you get to sell the asset now. You do pay taxes on these distributions, but generally at capital gain rates, and it's a great way to create retirement income for those of you that have a lot of equity in real estate.
Yeah, we would highly suggest you visit a highly qualified estate planning attorney to do any of that advanced strategy instead of taking a picture of that red little snapshot and go, Big Al told me to do this and I don't pay any tax and I get 10, well, something like that. Basically, what you want to figure out in a retirement income strategy is to have a little bit more balance in your overall assets. So if you want to sell real estate, how do you sell that to reduce the overall tax? You can exchange or put it into a charitable trust. Then you look at other asset classes. We talk about Roth IRAs quite a bit, and we believe that the next few years is the biggest opportunity for a lot of you to do Roth IRA conversions because of the recent tax law change. Because Al, if you look at it right now, $315,000 is the top of the 24% tax bracket. Last year, if you made that kind of dough, you were paying alternative minimum tax. You lost all sorts of exemptions. I mean, you're probably in the effective rate of what, 35 plus state, 45? It's a huge tax savings for people that are making a lot more money that they never looked at a conversion before because it's like, that's not going to make any sense. We believe it probably makes more sense than ever.
I think so too. And as you said, top of the 24% tax bracket, married taxpayer, $315,000 of taxable income, single, $157,500. And I can tell you, I completely agree with you, Joe, because most folks that were married that had that kind of income, at least in California and high tax states, were subject to alternative minimum tax. And their marginal rate because of alt-min was 35%. So if you try to do a conversion last year with this kind of income, you paid 35%. This year, you're paying 24%. That's an 11% savings. This is definitely a year and the next several years where you want to be considering Roth conversions.